All right, welcome everybody. My name is Julian Klymochko, I'm CEO of Accelerate. I'm here today to take you on a webinar talking about SPAC investing in the current market environment and how to capitalize on the swoon in SPACs. There's been a bit of a market correction, which I believe has unearthed a lot of interesting opportunities. So let's get into it today. First off, check out the disclaimer, forward-looking statements and things of that nature. Make sure you read this and do your due diligence prior to making any investment decisions. And this is not investment advice. So let's get into it. SPACs, to give you a bit of a background, each decade has been characterized by certain financial innovation. Like if we go back to the 1980s, the go-go 80s, this was really characterized by the leveraged buyout, which was this brand new thing back then, and helped fueling the LBO craze were junk bonds, high yield bonds invented by Mike Milken, which continue to this day. And they're just a normal asset class like anything else. And the 1980s can easily be characterized by the high yield bond, a great invention that came to fruition in that decade. Going to the 1990s, this was the decade of the mutual fund. We had star mutual fund managers, Peter Lynch, Michael Price gracing the cover of magazines, Fidelity Magellan was just absolutely crushing it, and mutual funds really democratized access to investing for middle-class America for the first time ever. Then take it to the 2000s. The 2000s were really characterized by complex credit products, whether they be MBSs, mortgage-backed securities, CDOs, collateralized debt obligations, CDSs, credit default swaps, all these complex credit derivatives that ultimately fueled a big credit bubble, which led to a housing bubble and then the 2008-2009 global financial crisis. These complex credit products continue to exist today, but in a much smaller form. 2010s, finished this decade about 15 months ago. I think the 2010s were really characterized by the ETFs, Vanguard, S&P 500, BlackRock, etc. Low cost access to investing for everyone. And then 2020s, it's early to call. We're only just over 1 year into it, but I believe the 2020s will be the decade of the SPAC. And why? I'll get into that today, but prior to really getting into the weeds on SPACs, I'm going to set the table by explaining what exactly is a SPAC, or a special purpose acquisition company. It's an acronym, also known as a blank check company. It's basically just a shell company. It raises cash, has a public listing, but no underlying business operations. It has a mandate to conduct a business combination or a merger with a private company over a fixed time period. So simply stated, a SPAC serves as a vehicle to bring a private company to the public markets. On just one thing, if you do have a question, put it in the chat and we'll get to the questions at the end. So feel free to use that chat channel and we'll get into those questions at the end of the presentation. I'll try to get through it relatively quickly in about half an hour, save a good half an hour for questions. So what does a typical SPAC look like? So the average SPAC will do its own initial public offering, an IPO, at $10 per unit. Notice how I said unit, not shares. SPACs are often in the form of a unit initially, which is one common share, plus generally a fraction of a warrant. Some of them have more funky structures, which include rights as well. But the most common structure is, call it one unit, which equals a common share plus a quarter or a third of a warrant. These warrants have standardized terms. They're exercisable at a 15% premium, so a strike price of $11.50. And the units generally split at the option of the holder into common shares and warrants after the 52 days post-IPO. So a SPAC raises capital, and what they do with this capital, they put it into trust and invest in low-risk short-term T-bills, and they're not allowed to touch that capital unless to pay tax on the accrued interest of those T-bills, or use it once they close the business combination, which comes at a later date. These SPACs have a fixed time period to conduct a business combination, On average, it's 24 months, of which if they don't, then they liquidate, they pay back shareholders $10 plus accrued interest, and the warrants are worthless at that point. But if a deal is announced, they do give shareholders the opportunity to redeem their shares for $10 plus accrued interest if they don't like the deal. And once shareholders vote it through, the deal tends to close 2 months later and changes the ticker, starts trading at this new public company. So there's over 500 SPACs currently in the US market today, and they all have generally standardized terms. SPACs as an asset class really came into their own in summer of 2020. Prior to that, it was really backwater. Not a lot of people knew what they were. Not a lot of people invested in them. But something happened, a certain dynamic, a switch flipped last summer that made them super popular, which is a cool dynamic that I'm going to get into later in this presentation. But I wanted to outline how much the asset class has grown in terms of IPO capital raised for SPACs. If we look historically, in 2019 was a record year at 13 billion. And now in March, we had like 13 billion in the first week of this month. So 2020, we had about 83 billion raised across 232 issues. And the chart on the right is per RBC. So in 2021, I've updated that information. Currently, there's been 76 billion raised in 2021. So it looks like we're going to smoke the record set last year, which was a good 6+ fold what happened in 2019. So growing like crazy. And if we look at the chart on the right here, it just shows starting in July 2020, issuance has been 10+ billion per month. I think in March 2021, we have a good chance of cracking 35 to 40 billion, which would just be absolutely insane. Pre-summer 2020, issuance was maybe 2 to 4 billion per month, but now it's at least 6-fold that. And the chart on the left shows how much the asset class of SPACs measuring market cap, how much it's grown. A year ago, it's 20 billion. Now it is 200 billion. So this asset class has grown 10x year over year, which sounds like a lot. Many people say, oh, you know, SPACs are in a bubble. There were 90 last year. There's now over 500. The asset class went from 20 billion to 200 billion. But I was just looking at a stat, the global private equity industry, there's 10,000 private equity funds controlling like 5 trillion of dollars. And if we look at venture capital is deploying, I believe, 300 billion per year. And the largest venture capital fund, the Vision Fund, is 100 billion, or half of the entire SPAC market. And a SPAC business combination, just to further give a relative perspective, a SPAC business combination is typically 3 to 5-fold the underlying cash and trust. So the cash and trust, call it, is around 180 billion, 170 billion, resulting in, if every SPAC did a business combination, this would result in about 600 billion of public company market capitalization. If we compare that to Tesla's market cap, that's like maybe one Tesla. So it has increased a ton over the past year, but it's still extremely small when looked at a relative basis. And I still think it has a lot of legs. Not sure if current pace of issuance will keep up, but nonetheless, this asset class has staying power and will be around a long time. So might as well get in on the ground floor, which is where we're at right now. What is the purpose of SPACs? People always ask, you know, what's up with these things? Why even have them? Well, SPACs, as I indicated when we started the presentation, they serve as a vehicle or a conduit to take a private company public. And the most common way of doing this prior to the past year, and in 2021, SPACs represent over 3/4 of all IPOs. So they're becoming the default way to take a company public. So prior to SPACs becoming popular, the main way of bringing a private company public was initial public offering or an IPO. However, if we look at IPO Dynamics over the past 20 years, you've had a large buildup of private capital that would keep growth companies private for longer and longer. For example, in the 90s, startups were going public very quickly within their first, let's call it 5-6 years. But these days, Some private companies are waiting 10 plus years to go public. Basically, the private company backers, venture capitalists, are waiting until they squeeze out all the growth and then utilize an IPO as an exit opportunity once there's no more growth opportunities. Meaning they're basically saving all the growth for private markets and using traditional IPO as an exit opportunity. We really haven't seen true growth companies use the IPO in a very long time, whether it be Apple or Google or Microsoft, Amazon, these companies going public really early stage, raising capital to fund their growth instead of just exiting onto retail investors. Then there's the notion of the direct listing. It's a very niche product. We saw Roblox use it. We've seen Slack use it. But other than companies that have tremendous access to capital, because a direct listing doesn't come with capital, and companies with tremendous brand, because you just sort of throw your shares out there and they'll trade for whatever they trade at. It's not for most companies. That brings us to the blank check company, SPAC, which is basically just a reverse merger. It is becoming the method du jour to take a private company public. Why? There are a number of main reasons of which a private company would pursue a SPAC. So number one, speed. Traditional IPO takes 12 to 18 months. You can complete a going public transaction with a SPAC in as little as 3 months. Secondly, marketability. So when you're going public via IPO, the S1 that you file, the prospectus, can only contain historical data. So a company going public via IPO cannot talk about forecasts. They cannot say what they expect to earn next year. They can only discuss historical performance. And they're very, the SEC is very strict of what the company can say. So they're in something that's called a quiet period, which makes it extremely difficult to market the story to investors. And what SPACs do, the way they sell the story, is many early stage companies are going public via SPAC, and their stories reliant on the future growth opportunities, i.e. their forecasts. The third reason would be certainty. Traditional IPO is kind of a broken process because the company won't know their valuation, their pricing until like the night before, and they're negotiating with typically hundreds of investors. Meanwhile, with a SPAC, they're only negotiating with one party, the SPAC sponsor, and they know the valuation when they strike the business combination well before listing. And then lastly, capital. The SPAC is proven to be a vehicle in which a growth company can raise the most amount of capital, more than you can find in the private markets, more than you can raise from venture capitalists, because in your standard SPAC business combination, the SPAC itself will have hundreds of millions of dollars of cash on its balance sheet. And then what we're seeing concurrently is a PIPE financing or additional capital come into the deal. So in a SPAC transaction, a $1 billion equity valuation company going public could say have $300 million coming from the SPAC and $200 million coming for the PIPE. You can't raise 50% of a company's market capitalization in a venture capital deal or any other types of deals. So that is the fourth advantages of utilizing a SPAC and why they have advantages over the traditional IPO. Now, prior to SPACs becoming popular over the past sort of 9 months, they were a very peculiar type of security and didn't fit the mold of a specific investor. Growth investors wouldn't buy them because there's no underlying growing business. There's no revenue growth. Value investors wouldn't buy it because there's no cash flows or earnings to appear cheap on. Quality investors wouldn't buy it because there's really no management. And then index or theme ETFs wouldn't buy it because there was no underlying business there. But given the similarities between SPAC investing and risk arbitrage, you've had arbitrageurs come into the space who are the main buyers of SPACs in the market. So I wanted to walk you through the circle of life of a SPAC from the perspective of the contingent of shareholders who own it. So from a SPAC IPO, it's largely hedge funds subscribing to this by $10 per unit. Hedge funds act as bridge lenders, effectively giving the SPAC sponsor 2 years to come up with a business combination. So once a SPAC sponsor announces a business combination for the blank check company, Their goal is to tell the story to investors, and generally it's retail investors coming into the stock, allowing hedge funds to exit, redeploy that capital into new SPACs, and retail investors want a piece of the pro forma entity or the private company that will soon be public. Once the deal closes, then you tend to see mutual funds and ETFs buying now that it fits their theme or their index. So that is the circle of life as to who would own a SPAC. So the recent popularity in special purpose acquisition companies was really due to two dynamics. So one is supply side, the other demand side. So getting into the supply side first, why do sponsors issue SPACs? Well, the number one reason is the tremendous profitability and how lucrative a SPAC is as a financial product. So typically the sponsor gets a 20% promote, of which they pay nominal dollars for basically 1/5 of the pro forma SPAC. So if it's a $200 million IPO of the SPAC, the sponsor could get as much as $50 million in shares. But it's not free. They do need to put up at-risk capital to fund the blank check company over its life. They got to pay the bankers' fees, which are 5.5% of the offering, 2% upfront, 3.5% deferred. You got to pay legal. You got to give the SPAC working capital, etc. So this at-risk capital is generally 3% of the IPO proceeds. So on a $200 million SPAC IPO, sponsor would have to put up $6 million, which is generally in the form of private placement warrants struck at $11.50. So given how lucrative SPACs have become, they become lines of businesses for alternative investment managers, such as private equity. We're seeing KKR, Warburg Pincus, Fortress, TPG, so many private equity funds getting into the space, venture capitalists, social capital, Dragon Eater, Postla, and also hedge funds, Pershing Square, Third Point, Starboard, Hudson Executive. So a ton of sponsors coming into the space just because it's probably the most lucrative financial product you can offer currently. Then on the demand side, there's a common misconception with respect to public market investors that existed for a long time. The misconception was that public market investors would only buy stocks of companies with stable revenue. They could make their quarterly EPS numbers that didn't have much volatility in their financial results, were profitable, and had steady revenue. However, what a certain deal showed, and I believe this deal was a Virgin Galactic deal, and Virgin Galactic, if you know, isn't forecasting profit or even revenue for many years out. And Virgin Galactic proved that there's tremendous appetite amongst public market investors for investment opportunities that were not only pre-profit, but often pre-revenue, where sometimes they weren't seeing revenue for 2025, 2026, 5-6 years out. So these opportunities were more analogous to late-stage VC, call it Series D or E-type rounds, that public market investors had a voracious appetite for, whether it be Hyliion, Lordstown Motors, electric vehicles, QuantumScape, ChargePoint, EV charging, Desktop Metal, Gaming, Rush Street Interactive, Open Door. A ton of these late-stage VC-type investment opportunities proved to be extremely popular in the public markets, and that's where the tremendous amount of demand came from. So recent SPAC performance had a great 2020, but that was really an abnormality. I would not expect a repeat of that performance ever. It was just craziness. 2021, roughly flat looking at the market. It is down 11.5% peak to trough. We track our Accelerate SPAC index, that orange line there. And over the past month, down about 9%, which is painful to some SPAC investors, but from my perspective, has made the market and certain opportunities within SPACs quite attractive. The top line just shows the average arbitrage yield, or if you just held and got your $10 plus accrued interest back on the average SPAC. So it's still slightly negative, but far less negative than it was previously. Looking at SPAC IPOs. So typically a firm like us, Accelerate, we like buying in the IPO. IPOs are generally only available to institutional investors. But what we're seeing in the market these days, there's been a flood of SPAC IPOs and the market's somewhat overwhelmed. So many of these are breaking price or trading at or below that $10 IPO price. Now, these are all SPAC units for the most part. So SPAC unit gets you the common share, which has a $10 net asset value or trust value, plus generally a fraction of a warrant. So on many of these, you can actually get them below their cash value, their trust value, whether it's Archimedes Tech, SPAC Partners. GNP Acquisition actually has $10.10 in trust. That's called an overfunded trust. Pine Technologies at a discount to $10. Digital Transformation, discount to $10. PWP and ESM. So we're seeing this across the board. Many SPAC IPOs trading at or below $10, giving retail investors the opportunity to invest at or below where hedge funds are getting in. So a pretty cool opportunity there, but you need to be patient for these. The average business combination takes around 10 months from IPO to announcement. So you got to put your money in and sit on it for a while. Don't expect anything to be announced soon. So what we like to do, we like to run a strategy called SPAC Arbitrage, and there's some great arbitrage opportunities available in SPACs these days. So we view the SPAC investment vehicle, the security, as offering a number of ways to generate return. So number one is the yield. So we get a baseline yield from the underlying accrued interest of the SPAC's trust value. So right now that's maybe 10 basis points. Nothing to write home about, pretty minimal. However, before the coronavirus pandemic, short-term rates were north of 2%. So you're accruing that 2% per year. In addition, if you can buy a SPAC at a discount to its net asset value or its trust value, including accrued interest, then that accounts for additional yield. But where the true beauty of a SPAC arbitrage strategy comes into play is the upside optionality. So number one, when you buy units, you get warrants, which can prove to be very valuable. For example, of the 400 and something odd SPAC warrants in the market currently, the average price is $2 per warrant. So that provides some upside on those units because you're basically getting those warrants for free. Then you have upside optionality on the stock. I think everyone remembers, whether it be Lordstown Motors, Nikola, DraftKings, any of these companies went up significantly above their $10 trust value or $10 plus accrued interest trust value. And that offers that tremendous upside optionality where you could buy a SPAC at $10 and a year later it's announced deal and now it's trading at $15, $20, $30. I mean, we have seen, I won't name names, but we did see one SPAC go above $60, which is absolutely madness, but it does happen. I don't think that specifically will happen again, but it's not unheard of to see a SPAC trade north of $20. So that 100% upside is pretty significant. But the most important thing that I think on SPAC arbitrage is the downside protection that we'll get into. But I wanted to give you a case study on SPAC arbitrage. So this specific SPAC, if you look at the graph on the right, Vecto IQ, infamous because they did a business combination with Nikola. And this really demonstrates how a SPAC arbitrage trade works. This is in the common shares. If we look at the blue line, this is the share price of these SPAC common shares. So back in May 2019, you could buy it at around $10. Meanwhile, the NAV, which had been accruing interest, was at about $10.30. So you could earn that 3% arbitrage return. And then fast forward to early 2020, they announced a business combination with Nikola, allowing arbitrageurs to not only earn that 30-cent spread, but you could earn, $2, $3, $4 to the upside as it rallied significantly above the cash value. This is what we call the SPAC pop. Hasn't been happening much these days, but in a normal market environment, it happens when investors get keen on the story and they bid up the stock significantly higher than its cash value. So we owned all of these in the Accelerate Arbitrage Fund, buying at or below $10. We see CIIG merger. They announced a business combination with a rival, an EV vehicle company. They rallied to north of $30 from around 10. Pivotal Investment Corp 2. They did a deal with, was that the XL Fleet deal? Nonetheless, there's a lot of pivotals. But nonetheless, yeah, they rallied to nearly 20. And then Longview, which did the a Butterfly Network deal. They were up over 50%. So that really demonstrates the SPAC pop. That upside optionality that you can give yourself exposure to buying SPACs at or below $10. But what we really like about SPAC arbitrage is the low risk nature of it. So if you buy a SPAC at or below $10, we know that within 2 years, we'll have the option of redeeming our shares for $10 plus accrued interest. So we always have that backstop. Certainly could trade down in the meantime, so it's not risk-free. However, as long as you're not forced out of the trade, it's a very low-risk proposition, which we consider SPAC arbitrage, upside optionality, this potential upside of equities combined with the risk profile of treasury bills, as long as you're buying it at the right price. Basically, I'm saying don't pay too high of a premium over the net asset value, if any. So SPAC arbitrage in units. These are the units that you can buy in the IPO market. These are the units that you can buy in the secondary market right now for the new issues today that I listed earlier on in the presentation. You can buy some at or below $10, which gives you the common shares plus the warrants for basically free. The average warrant trades at $2 per share. And so when you can buy a SPAC unit at or below $10, I mean, the warrants tend to have value. And of the 107 SPACs that have announced a business combination, on average, they're trading north of $12 per share, or about a 23% premium to their net asset value. That displays this upside optionality. So I think buying a diversified basket of SPACs at or below $10 makes sense because of this resulting premium post-business combination announcement. And how long can this take? Well, of the 107 SPAC business combinations currently announced, they've taken 240 days on average from IPO to the announcement of this business combination. Now there's some great arbitrage opportunities in shares, which is nice to see. In January, there's the first time ever that I saw there were no positive arbitrage opportunities. But what this measures is it looks at a SPAC and compares it to its net asset value and looks at the annualized return that you can earn to effectively the liquidation date or the vote date coming up. So there's many opportunities to earn north of a 2% annualized return in a low risk manner. And some people aren't too impressed with 2%, but when short-term yields are 10 basis points, 2% is a not bad return. So we got all of post-SPAC equity trading dynamics. So we call it a post-SPAC equity once the redemption date goes away. And so the redemption is what provides that low risk nature of SPAC arbitrage, because the redemption allows you to get your $10 back plus accrued interest. The redemption happens 2 business days prior to the vote. And once that redemption date lapses, you lose that downside protection. And in my opinion, it is no longer a SPAC. It converts asset classes from a SPAC to a post-SPAC equity that can trade, $2. I've seen some post-SPAC equities trade down very quickly after the deal closes. So measuring performance from the $10 IPO price, 72 SPAC business combinations over the past year. Average gain of nearly 62%, which is great. I mean, some outperformance there. However, a median gain of just 28%. So post-SPAC equities follow somewhat of a Pareto distribution. Many losers, a few winners, such as DraftKings, etc., that bring up the average. So be careful with post-SPAC equities. How to redeem SPACs. I see a lot of people mess this up, quite frankly. So I consider SPAC arbitrage a low-risk strategy. However, if executed improperly, it can become a high-risk strategy really quickly. I often have investors calling me, messaging me, retail investors, even institutional investors say, hey, what's going on with the SPAC? It's at $8 down 20%. I thought these were low risk and wouldn't go below 10. Well, turns out they missed the redemption date, which is such a key date to not forget about. I consider SPAC arbitrage simple, but not easy. It's tough to operate because you need to pay attention to every single filing. You need to know every single redemption date. Redeeming is real hard if you're a retail investor because many of the platforms aren't really equipped to handle it very well. But as an institutional investor, we have a full-time team taking care of this stuff. And so it's something that we pay attention super closely because you don't want to miss that redemption date. On SPACs trading at a discount to NAV, it's arbitragers holding the price in line, and once that arbitrage bid leaves the market after redemption, sometimes it's lookout below on post-SPAC equities. Another thing I wanted to touch on with respect to a SPAC investment strategy is I think it's a really great alternative investment. And the reason I consider it an alternative investment is SPACs have historically had low correlation to stocks and bonds. For example, if we rewind the clock back to early 2020 and look at the first 5 months of 2020, the most volatile market in history, when the VIX hit 85, we had the fastest bear market in history. The S&P 500 dropped 35% in as little as weeks. So during that time period, if we look at the chart on the right, we have our Accelerate SPAC index in the blue line, and then we compare that to the global bond portfolio in the orange line, the Bloomberg Barclays Global Aggregate Bond Index. So how did bonds do? Well, over the first 5 months of 2020, bonds returned 2.1% with a volatility of 7.7% and a peak to trough drawdown of nearly 9%. Compare that to SPACs. SPACs returned almost double in the first 5 months of 2020, almost 4%, with a volatility of just 5.3%. So 31% less volatility than bonds, and a drawdown of just 6.6%, which is a 25% lower drawdown than bonds. That was pretty phenomenal performance for SPACs, tried, true, and tested in the most difficult market environment that any of us have ever seen, most volatile on record. The other thing I'd say about diversification is over these first 5 months of 2020, the SPAC index actually had a negative correlation with both stocks and bonds, which is how you measure true diversification, is zero or negative correlation to traditional asset classes. So how to access SPACs? You can obviously buy single SPACs in the market through your discount brokerage account. I run a fund, an ETF called the Accelerate Arbitrage Fund ETF. The symbol's ARB on the TSX. It's the world's first SPAC-focused ETF. It's done very well. And we have a diversified portfolio of about 160 SPACs in the portfolio. We're pros. We've been doing this a long time. Like I said, the world's first. And I think it's an interesting strategy. If you want diversified exposure to SPACs where someone can run it for you, could be worthwhile looking at the Accelerate Arbitrage Fund, symbol ARB on the TSX. In conclusion, SPACs are definitely worthwhile paying attention to. They're here for the long term. They've gone up 10x year over year in terms of market cap. There's now over 500 of them outstanding, and they're the default way for private companies to go public, with 75% using a SPAC in 2021. From an investment perspective, we like it. We think it's heads we win, tails we win big, because you got this low risk nature as long as you're buying at the right price, i.e. $10 or below, and then you have this upside optionality. So we like the risk profile combined with high potential upside. Investors like post-SPAC equities because it gives them access to earlier stage growth opportunities, and sponsors like them because they're quite lucrative. But nonetheless, from an investor's perspective, we believe SPAC arbitrage presents great equity upside with mitigated downside potential. And we've been running the strategy for a while, and it's tried, tested, and true in the market. And given the unique and attractive characteristics of SPACs, we think that they deserve a spot in diversified portfolios. So if you want to reach out, my contact information's there. Definitely give me a follow on Twitter at Julian Klymochko, and I can move on to questions at this point. So let's get into the questions. All right. So if you do have questions, make sure to put them here. So someone says, are post-deal SPACs a good short? You know, it really depends. I have seen some attract short interest, but it's the same thing like anything else. I mean, there's great shorts just in the general market, and I'm sure there's great shorts in post-SPAC equities. Like I said, they generally follow a Pareto distribution, some big winners and a lot of losers. So on average, they've done well, but on a median basis, they've underperformed. So if you're thinking about shorting post-SPAC equities, that's something to keep in mind. It's not a strategy that we follow. We like to buy pre-deal SPACs, and that's where we see good performance coming from. Could you tell us about your SPAC exit strategy? How far in the SPAC lifecycle does your fund hold SPAC? So we view ourselves as a bridge lender. So we provide capital to sponsors for them to pursue a business combination. And once they announce it, it's their job to market the deal to new investors, allowing us to get our capital back and recycle into the next deal, because we see sponsors executing subsequent SPACs. So we like to continue to support them. So for example, after a business combination, it's generally 3 months between announcement and closing. We commence a systematic exit process in which we will divest the position between announcement and closing. Okay. So that question was from Christopher. The one before was from EH. Question here from James. He says, what would be the impact on the asset class if the SEC were to loosen restrictions on forward-looking statements for IPO/direct listings? Yeah, I think that's a risk, because that's one of the main advantages of SPACs. There's 4 advantages. One is the marketability, or the ability to discuss forward-looking statements. I personally don't understand why the SEC would restrict that. I mean, what public company doesn't give forecasts and guidance? At least they have sell-side analysts covering it, giving estimates. So I think investors rely on estimates, forecasts, and forward-looking statements. So if that happened, I think, yeah, it would be a net negative for SPACs, but I ultimately don't know, the complete result. Who knows? People thought that direct listings may kill SPACs, but thus far we've seen like 1. So thank you for that question. This one from Eric. You mentioned overfunded trust. Where do you find if a SPAC has an overfunded trust in the filing? If so, which one? Easiest way is to look in the S1, which is the prospectus. They will disclose the initial net asset value, typically at the bottom of the first page, and when they're mentioning the redemption process in the overview of the security. So do the S1 and you can find it. From Paul, where can we find a list of SPACs and the redemption dates? So look at go to accelerateshares.com. We put out a monthly SPAC monitor of every SPAC out there and time left within their life cycle. So you can find that there. SPAC monitor by Accelerate Alpha Rank, we call it. So from Jay, he said, do you think investor sentiment has changed significantly after the recent big declines in SPACs, and SPACs will remain depressed for the rest of the year? How do you think the rest of the year will go? So the recent decline, we've had 4 of those declines over the past year. We had one in March 2020. We had one in July 2020. We had one in October 2020. And now we had one in February and March 2020. So these things happen. The SPAC market changes very quickly. Highly volatile, and sentiment goes from positive to negative at the snap of your fingers and can flip the other way. Personally, I think the market's probably bottomed, or at least close to, and I think sentiment will continue to improve from here. It's just that things continuously get overheated, we have a correction, and then it just restarts. That's been the nature of SPACs. And I think we'll go through a number of corrections through 2021, but I mean, the pattern will be up and to the right with some volatility. So from Doug, any plans to register your ARB ETF for US trading? Broker Schwab requires a global account to trade your ETF. It's a question we get a lot. We love our US investors, and thus far, the only way we figured out how US investors can access ARB is through Fidelity or Schwab Global. We'd love to open that up to additional investors. So we are considering various things, but no concrete plans yet. There's no more questions. That covers everything for today's. Oh, got one, actually got a few more. Sorry, not going anywhere yet. What's your process for valuing a warrant? Well, warrants are tricky to value. This one is from James. Basically, we don't hold warrants long-term. We exit around the business combination. And so we're not warrant players. We don't buy warrants. We basically get warrants for free as part of the business combination. If you are trading warrants, I encourage you to read the S1 to make sure you understand all the terms. the strike price, the term of the warrant, whether it has a crescent term to it, the redemption price. Sometimes they have anti-dilution provisions, whether management can call them or force cashless exercise, because it seems like every single SPAC warrant is different. So make sure you read all the terms such that you can value it correctly. Okay, from B. How high would you pay for an elite sponsor on an IPO? 1060, 1080, 11. Leap use started greater than 12. Yeah, we don't pay a premium. We found some of the most successful SPACs were from the most under the radar sponsors, and some real stinkers were from high profile sponsors. So perhaps there's some correlation, but we don't like paying for it because we like the downside protection and low risk nature of buying at or below $10. That being said, in the arbitrage fund, we did subscribe to all 3 SoftBank SPAC IPOs, bought at $10. I mean, you can't really buy it in the market at $10. But that being said, like when Coastal Ventures IPO'd a few days ago, I saw it trading at 1020. I thought that was a decent buy for investors. We didn't buy it personally because, like we said, we run an arbitrage strategy where we buy at or below $10. But I thought Coastal at 1020 was quite the steal. But no position in that one. Okay, another one from B. Do you think that with the daily 5 to 10 SPACs that it will cause all non-announced SPACs to be 10 to 1050 now? No, that's a good point. I continue to believe we'll see a dramatic slowdown in IPO issuance. So many are breaking price, and a lot of the money will leave. I spoke to an underwriter today. They said a month ago all their deals were 10x oversubscribed. They recently did an IPO today, and the book was barely 1 times covered. So it gives you a sense of how things have changed dramatically. And I think that foreshadows a massive slowdown in issuance. And once we get that, the market will kind of pick itself up off the mat. And like, it's not going to get as crazy as it was in January and February, where pre-deal SPACs were trading at $15, $20, even $60 per share. But I think in terms of SPAC pop, if you can see something go to $12, I think that's a pretty tremendous return. And we will see that, I think, in my opinion. Okay, another one. So this is from Cam. I'm from the UK. We require the ETF to be MIFIF compliant. It's a SPAC fund, MiFID ready. Unfortunately, we're not. That's not been something we have had time to look into, but I'll note that and we'll try to get that done for you, Cam. Another one from B. What have you heard about PSTH, the Pershing Square SPAC? I don't speculate on these things. I don't really know much about it, no position in that one. But I do caution investors because it's at a very lofty premium, so expectations are quite high. And if you compare that to Pershing Square's closed-end fund, which is at a double-digit discount, I don't necessarily understand either of those dynamics. But I do like Bill Ackman, so I'll say that. James, do you expect to see 1010 to 1020 trusts and 1/2 warrant coverage in the near future for new SPAC IPOs? I think that's a decent comment. What we've seen over the past 2 months is warrant coverage decline dramatically. Historically, we've seen 1/3 to 1/2 of a warrant. And now it's been like 1/5 to 1/4, if any. We're seeing more and more warrantless SPACs, more and more with 1/5. I've even seen like even lower than 1/5, which is sad and frustrating. Prior to today, we haven't seen an overfunded trust at 1010 since February 9th. We saw our first one emerge today. And with the morbid trading, weakness and demand, I mean, from a SPAC IPO today, I heard it directly from an underwriter that coverage went from 10x oversubscribed to basically 1x, right? So there's been a massive decline in investor demand, and you can see that in the trading. And I believe SPAC terms, overfunded trusts, better warrant coverage will work in investors' favor on a go-forward basis. So expect that to start coming through soon. We'll start seeing more and more SPAC IPOs downsize. We'll see more weak trading, and we'll see sponsors have to offer more to investors to get their deal done. So that does mean more overfunded trusts and better warrant coverage. One from EH. Are you concerned about how this vintage will perform because there's so much capital chasing few deals, so everyone is going to be overpaying for not great companies? You know, the notion of valuation and overpaying, that's always been a concern and certainly is heightened with more SPACs outstanding. But always what helps anchor that is the PIPE financing. So the dynamics these days is such that if you announce a business combination, it basically has to include a PIPE financing, and PIPE financing underwritten by name brand investors validating the valuation. And if the valuation's too high, and if the stock won't perform well, then you won't get the PIPE investors. So that is one thing that helps anchor that valuation to more reasonable levels. Not saying there isn't potential for froth and overpaying, but I think it helps mitigate that risk. So guys and gals, that is it for today. Thank you for all your questions. Thank you for joining us today. I had tremendous turnout. Love to see it. Glad you're interested. Happy to do this. Hopefully you learned something. Definitely follow me on Twitter at Julian Klymochko. Check out the website, accelerateshares.com. If you're interested in learning more about SPACs, also we got a podcast, Absolute Return Podcast. Give that a listen to as well. Feel free to reach out if you have any additional questions. Have a great day. Bye, everybody.